Ladies and gentlemen, good day and welcome to Dollar Industries Limited Q3 FY26 earnings conference call hosted by Anand Rathi Share and Stock Brokers Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Anjali Oja from Anand Rathi. Thank you, and over to you, ma'am.
Thank you. Hello and good evening to everyone. I thank you all for joining the Q3 and 9M FY26 conference call of Dollar Industries Limited. Today, from the management, we have Mr. Ankit Gupta, President, Marketing, Mr. Gaurav Gupta, Vice President, Strategy, and Mr. Ajay Patodia, Chief Financial Officer. So, without any further delay, I would now like to hand over the call to the management for their opening remarks. Over to you, sir.
Thank you, Anjali. Good evening, everyone, and thank you for joining us today. We thank our shareholders, analysts, and stakeholders for their continued trust and support. Your confidence allows us to remain disciplined in execution, uphold strong governance standards, and stay focused on long-term value creation. I would also request everyone to take note of the safe harbor statement in our presentation. Turning to the operating environment, the industry continues to face intense competition and sustained pricing pressures. In this context, the company has deliberately adopted a margin-first strategy anchored in cost discipline and operating leverage. Our approach is not about choosing between growth and profitability, but about sequencing them correctly, prioritizing earnings, quality, cash flows, and returns in the current environment. During Q3 FY26, demand conditions remained steady. Operating revenue for the quarter stood at 388 crores rupees, reflecting a year-on-year growth of 2%. While top-line growth was measured, our sustained focus on cost efficiency, operating discipline, and product mix helped us maintain healthy operating performance. Gross profit for the quarter increased by 4.6% year-on-year to 142 crores rupees. Gross profit margin expanded by 91 basis points to 36.5%, reflecting the benefits of disciplined sourcing and an improved product mix and tighter cost control. For the 9 months ended FY26, gross profit stood at 447 crores rupees, registering a growth of 10.7% year-on-year, with margins expanding by 72 basis points to 35.5%. Operating EBITDA for the quarter stood at 39 crores and remained largely stable year-on-year, with margin at 10%. This performance reflects our clear focus on protecting operating profitability through efficiency improvements and operating leverage, despite a challenging pricing environment. For the 9 months ended FY26, operating EBITDA increased by 12.6% year-on-year to 142 crores. Operating EBITDA margin expanded by 41 basis points to 11.3%, underscoring the impact of structural cost initiative and improved operating leverage as volumes scaled. Given the current industry dynamics, we believe that maintaining cost discipline, leveraging our operating structure, and protecting profitability is the most prudent and sustainable approach. As the operating environment normalizes, growth is expected to follow, supported by a stronger cost base and improved operating leverage. For this fiscal year, we reaffirm our revenue growth guidance of approximately 11 to 12%. We expect EBITDA margins to remain stable in the range of 11.5 to 12%. We remain opportunity-led on growth with a clear focus on returns and cash flows. Now, Gaurav will provide further details on the business and operational highlights of the quarter.
Thank you, Ankit. Let me now highlight some of the key business and operational trends during the quarter. During Quarter 3 FY26, total volumes grew by 2.4%, while for the 9 months ended FY26, volume growth stood at healthy 8.5%. We also continue to witness steady traction across modern trade, e-commerce, and quick commerce channels in Quarter 3 FY26. Collectively, these channels contributed 12.8% of overall revenue during the quarter. For the 9 months ended FY26, these channels recorded strong value growth of 36% and volume growth of 38.9%, contributing 11.6% to overall revenue. On the exports front, we delivered a value growth of 10.9% in quarter 3 FY26, with exports accounting for 5.6% of overall revenue for the quarter. Coming to our brands, Sports NXT continued its strong momentum, registering a year-on-year value growth of 26.5% and volume growth of 48.1% in quarter 3 FY26. For the 9 months ended FY26, Sports NXT achieved a value growth of 16.7% and volume growth of 27.1%, reflecting increasing consumer preference for differentiated high-quality products. Additionally, Champion, our kidswear range, recorded a robust performance during the 9 months ended FY26 with value growth of 30.5% year-on-year and volume growth of 5.8%. Our strategic partnership with GOAT continues to yield strong results, supported by continued traction across modern retail and quick commerce channels. In quarter 3 FY26, revenue was 13.71 crores, reflecting a 43.9% year-on-year growth. For the 9 months ended FY26, revenue increased by 50% to almost 39 crores. PAT for the quarter stood at 1.65 crores, up 45.1% year-on-year and 57.1% quarter-on-quarter, with a PAT margin of 12%. With that, I would like to invite our CFO, Mr. Ajay Patodia ji, to take you through the financial performance. Over to you.
Thank you, Gaurav. Good afternoon, everyone, and thank you for joining the call. Let me take you through the financial performance for quarter 3 and 9-month FY26. For the quarter, operating income grew by 2% year-on-year to rupees 388 crore, supported by steady demand and an improved product mix. Gross profit increased by 4.6% year-on-year to rupees 142 crore, with margin expanding by 91 basis points to 36.5%. Reflecting better mix and disciplined cost management, operating EBITDA stood at 39 crore with margin maintained at 10.0%, demonstrating our continued focus on protecting profitability despite a dynamic operating environment. As highlighted by Ankit earlier, we have continued to maintain stock cost discipline across the organization. Advertisement spends were rationalized to 6.5% of operating income in 9-month FY26, and we expect this ratio to moderate further in the coming quarter as operating leverage improves. Profit after tax for the quarter stood at rupees 18 crore, translating into a PAT margin of 4.7%. For the 9 months ended FY26, operating income grew by 8.4% year-on-year to 1259 crores. Gross profit increased by 10.7% year-on-year to 447 crores, with margin expanding by 72 basis points to 35.5%. Reflecting continued improvement in mix and cost efficiencies, operating EBITDA rose by 12.6% to 142 crore, with margin expanding by 41 basis points to 11.3%. Driven by operating leverage and structure cost action, profit after tax stood at 75 crores, registering a strong growth of 21.1% year-on-year, with PAT margin expanding by 63 basis points to 5.9%. The company generated operating cash flow of rupees 60 crores as of December 25. With no major capex commitment in the near term, the focus remains on enhancing free cash flow and further reducing debt. Now I would quickly run through the brand-wise contribution for the quarter. Our dollar main category, Big Boss brand, contribute around 36%. Our economic segment, Dollar Always Leher brand, contribute around 37% contribution. Our women segment, Dollar Women Missy brand, contribute around 7%. Our premium segment brand, Force NXT, which increased during the quarter in volume by 48%, is contribute around 5%. And Dollar Thermal, our winter wear product, contribute around 12% in this quarter. Overall, our performance reflects the impact of disciplined cost management, operating efficiency, and improved product mix in a competitive environment. Our focus during the quarter remained on protecting margin, strengthening earning quality, and maintaining financial prudence. We will continue to prioritize profitability and operating leverage while remaining selective in pursuing growth opportunities. As market conditions stabilize, our strengthening cost base and structure approach position us to drive sustainable and balanced growth. With this, we now open the floor for questions. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Samir Gupta from India Infoline. Please go ahead.
Hi, good evening, sir, and thanks for taking my question. Sir, firstly, I believe you've reiterated the full year guidance to 11-12%. Now, 9 months we are at 8%, and this would still imply a 15% plus kind of a growth in fourth quarter, which is the only remaining quarter. In the presentation, you have said that competitive intensity is high with pricing pressures, and your focus is also on profitability in this time. Would it not be a tall ask to go from 3% growth in the current quarter to 15% plus in a matter of a quarter then?
So what happened is third quarter usually is a bit slow because of winter sales and seasonal product sales, and fourth quarter is always heavy for our industry. So we are very hopeful that we'll be able to do this 15% kind of a growth, so that we stand somewhere between 11 to 12% overall growth.
And if you're looking after Sumit, you analyze our last previous year turnover in this quarter, you will find that 35% of the total revenue come from this quarter only. And this is the heaviest quarter in our overall in full year. So we are very hopeful that we get our result.
Sure, sir. Sure. Fair, sir. Second question, sir. I mean, even if I look at the other company results, some of them are yet to report, but Page has reported, and they have been witnessing a modest growth all along. Now, growth for you is also kind of slowing down. Innerwear as a category, we would really relate it to being a very staple kind of a category. Ups and downs are relatively less. So, and in your segment, I would say that the typical competitive pressure from the D2C brands or the higher growth brands is also not very high. So just to give a color, what exactly is happening on the ground in this category? Are we really seeing heavy discounting? Why, and why is that? Because overall, is consumption really slow? What is your sense, sir?
So thing is that the industry has been growing at a CAGR growth of around 7%, and seeing our 9 months achievement, like a growth achievement, it's somewhere around 8.5%, and we'll be growing over and above that only. And if you look at the competitors also, like Page operates in a very different market segment, but if you look at our immediate competitors also, like we are 3 in the listed space, 2 in the non-listed space. So overall, there are 5 companies at a similar level with revenues being 15% plus and minus, so here and there, right? So past 5 years we have been one of the fastest growing company in our segment, and this year also we are very hopeful, and we are working towards the guidance that we have given. We are working towards that only, and we are very hopeful that we'll be able to achieve that 11 to 12% which we promised.
Fair, sir. My question was on this industry growth of 7%. I mean, is this not a little underwhelming that a category like innerwear, where there is still a large unorganized piece, is only growing at 7% CAGR? I believe you are saying on the organized side, the 7%.
No, that's the overall industry data that has come in, which includes the organized as well as the unorganized.
Actually, it is our industry is very unorganized. In men's segment it is only 60% organized. In women's segment it is around 30-40% organized, and each segment is 100% unorganized. So the study is done by the Wazir. You get the presentation at the Wazir website. So according to Wazir and some report also, E&Y doing one survey, so they refer that the industry grow around 7 to 8%.
Got it, sir. I'll come back in the queue for follow-ups. Thanks.
Thank you.
Thank you.
Thank you. The next question comes from the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. Thank you for this opportunity. So, you said that the industry is going through a difficult competitive environment. So, I would like to understand that you had earlier guided that we should be aiming for about 12 to 13% EBITDA margins and sustainably reach 14% over the medium term. So, I would like to understand, in FY27, would we be targeting better EBITDA margins? And if so, what initiatives are we taking in that direction?
So, definitely, we are working towards that. In fact, the entire company has been aligned towards this thing only, that how we increase our profitability over time. Before COVID hit us, we were already standing at somewhere around 13.5% kind of an EBITDA. But the highest was 16%, which we went in FY22. 16.5%, but because that was mainly because of the increase in the raw material prices. Over time, I think in our industry, the segment where we operate, it would be nice to say, or the sustainable level of EBITDA that we look forward to is somewhere between 14 to 15%, keeping in mind the operating leverage that we get at a certain level of volumes. And so this year we'll be doing somewhere between 11.5 to 12%, and next year will definitely be better. And in next couple of years, I think we should be somewhere between 14%.
All right. So, with 11% growth, we would be around 1850 CR revenue this year. And you said that, operational leverage would start kicking in once we reach 2000 CR type of a revenue. So, do we expect to reach 2000 CR in FY27? And I just would like to understand, are there any initiatives that we're taking to improve our EBITDA in FY27, or will it just kick in through operational leverage? And are we taking any price hikes in FY27 or increase in the share of value added or our premium segments in FY27? I just want to hear your take on this.
So it won't be only driven through operating leverage, but there'll be ASP change also in terms of product mix change. As you can see, last 3 years, our Force NXT, which is a premium brand, which has a higher EBITDA, which contributes higher EBITDA also, has been growing around 25 to 30% year-on-year basis. And this year, 9 months ended also, it has been growing around 27-28% kind of a growth we are seeing in that particular premium range. So I think that will also help us in the mix change and gross profit increment. Plus the new unit that we have put in, the spinning unit, the increase in the spindles which we did a couple of years back. So last year only the production just started. So we can see some amount of efficiencies coming in from there as well.
Also, can I add something to it? Hello?
Yeah, please go ahead.
So the thing is, while listening to your question, and you told, will there be a price hike or something like that? So see, what happens is we're talking about, next financial year 27. So it's very difficult right now to predict, how cotton is going to react, if the raw material price is going to go up or if it's not going to go down. Current situation of exports also, if you see, with the Trump slapping so many tariffs, then again going down, and all of a sudden now he's removed the tariffs. So, the market has gone more tighter with the, yarn rates coming up and again. So the market right now is extremely volatile in terms of raw materials. So unless there's a very high rate increase or price increase in raw materials, ASP hike is very difficult given the competitive nature of what industry is going through right now. So if there's definitely a good amount of change in raw material prices, then definitely there'll be a price hike.
Got it. All right. Thank you very much. So my last thing would be that we pay dividends of about 17 CR every year. So with the new tax regime, buybacks have started falling under long-term capital gains or short-term capital gains. So they are being treated as capital gains. So I would request you to consider doing buybacks instead of paying out dividends as they're tax efficient, and they also extinguish outstanding shares and serve as a reward for long-term investors. So I would just like you to consider that. Thank you very much.
Thank you.
Thank you. The next question comes from the line of Varun from Equity Capital. Please go ahead.
Hi, sir. A couple of questions. Firstly, if you could provide the trade discounts and the promotion-led cost for the quarter.
All the trade discount incentive around 6 to 6.5%.
Okay. And secondly, you said the industry is growing at only 7 to 8%. So how do you think that this will change? What would trigger a higher growth, and when should that happen? Hello?
So it would be very difficult to say that how the industry will grow at 10 or 11%, but surely we can say about ourselves, like at Dollar Industries, we really aim to grow double digit for next 2 to 3 years, and at least. So yeah, so we have been working on that. We have changed our go-to-market strategy. We are implementing a lot of technological changes in the company. We are limiting our advertisement costs or shifting our advertisement costs to digital media as well. A huge chunk goes to digital media now, which didn't used to go earlier, and focusing on our premium products. So all these things will entering into new categories like dollar rainwear that we started 2 years back. So all these things taken together will really help us grow at a much faster rate than any other company or the industry.
My point was if you think that the industry will grow at this rate only for next 2 3 years, then that will also limit your upside for the growth. So,
but if you see the other players in the industry also, like people are shifting from unorganized market to organized market, and then in our segment and space also, there are 5 companies, and few of the companies have been going through some issues also. Won't be naming the company, but so all those market share gain that you can do in the market will really help you grow at a faster rate.
okay. And what is leading to this overall pricing pressure? Is it because of competition from unorganized or majorly from the organized side?
Basically, this is due to market condition only, not any. We can not any analyze that whether it is organized or unorganized. But sometimes it is due to some issue with industry also. But now it is settled down, and from now onwards, we hope that we get the good improvement in the pricing also, and already there is some increase in the yarn prices also, or we hope that we also increase our ASP in the coming future.
Okay, sir. Thank you.
Thank you. The next question comes from the line of Prerna Jhunjhunwala from Elara Securities. Please go ahead.
Thank you for the opportunity, sir. So just wanted to understand, this competitive intensity has been there from a long time, and it has been, is there any sign of easing that off, or it continues to remain high as earlier?
No, so it's not like what we saw 9 months back, but it's easing out, but it's still there. So which is causing a bit of a problem. But we are very hopeful that in few months time, or maybe 2-3 months time, it should get settled down.
So how are we going to progress on distribution expansion project, which is Lakshya? with easing competition. This year has not seen any major improvement over there.
So, yeah, in Lakshya project, our contribution coming in from Lakshya project has been 32%. This 9 months ended, if we look at the 9 months ended figure, which is up 1% from last year. But yeah, no addition in new distributors. But we are very hopeful ki as soon as things get stabilized, we'll again restart the project and enter into new states, like few of the states which are in WIP, like Bihar, Jharkhand, Maharashtra. So we'll be working on that, and we'll try and complete. But overall, wherever we have completed the Lakshya project 100%, we are getting good results over there till now, and still they are showing good sign of improvement, even after the pricing issues that we are seeing in the market.
Could you elaborate on this? This would be really helpful. How much is the growth that we are seeing in Lakshya project, which is 100% complete states, and maybe WIP and non-Lakshya?
So if we see that 9 months ended, like a few of the states, if we talk about Haryana, if we talk about Andhra Pradesh, Andhra Pradesh grew by around 20%, Haryana grew by 11%, then if we look at Odisha grew by 24%, Maharashtra is growing by 10%. So Maharashtra means Mumbai and surroundings, which is 100% completed. So all these states is doing really well, and we are very hopeful about the project. So we have not given up on it. It's just that there's some delay because of the market situation, but yeah.
So these kind of high double-digit growth rates that you're talking about, which means in our base states, are we losing market share, or the market is only growing or degrowing maybe? I'm not able to understand these growth rates in detail.
Sorry, I didn't get your question.
The question is, if in Lakshya project states you are getting double-digit growth and you've grown about single-digit in overall sales, then your other non-Lakshya states are either single-digit, low single-digit, 2 to 4%, or even maybe even negative. So just trying to understand this math behind this, like how are which areas we are facing issues.
The thing is, hello, am I audible?
Yes, sir, you're audible.
So, Prerna, the thing is that I just gave you the examples of few states, right? There are some states which are growing by 2% also, 5% also, where we saw some problem. And like in South, if you talk about Karnataka is growing by around 1%, 2%. Up till in 9 months ended because of some issues with the distributor. So I just gave you the overall impact कि overall अगर हम देखें कि 8.5% 9 months ended में company level पे है, so with respect to Lakshya we are growing at around 10%.
Okay.
So the growth we are seeing in Lakshya project is around 10%. I just gave you some examples where we have completed 100%. What kind of a growth are we are still seeing in some of the states which have matured.
Understood. So we're not losing market share in your opinion in any of the states that you...
Definitely not.
Okay. And to protect that market share, we are holding on to our prices is what is how the things are moving.
Yeah, so if someone is involved in the deep discounting of, let's say, 4 to 5%, we are in we are giving around 1.5%. We are not going down to 5% kind of a thing, and we are very sure about it internally also that we won't be doing that.
So in that case, you are still getting volumes from your distributors, and you are sure that you are not losing market share over there despite this strategy, which talks about the brand pool is what I'm trying to understand.
So that is being created over time. So it's a process. When we changed our brand logo and the entire overall structure, also brand restructuring that we did. After that, also we got a really good positive feedback from the market, and that time also I told everyone that it's a gradual process and it will happen. It will create some pull for the brand. And if you see our second quarter also, or the first quarter also, now we are seeing that impact in the market, in fact the retailers are the biggest brand ambassador for the companies, right? In our industry, MBOs actually act as your brand ambassador, and their word of mouth, their loyalty towards your brand really assures the consumers ki yeah, we can go ahead with this particular brand. And through Lakshya project, we have been able to create that kind of pull.
Understood. So that's fantastic to know that we are gaining or at least holding on to our market share. All the best, and
thank you so much.
Thank you, sir.
Thank you, Prerna ji.
Thank you. The next question comes from the line of Bhargav Buddhadev from Ambit Asset Management. Please go ahead.
Good afternoon, team, and thank you for the opportunity. Sir, if you look at the volume growth for 9 months of about 8% and in this quarter of about 2%, and if you look at your gross margins as well, there has been an improvement both in 9 months and this quarter. So in this competitive environment, if you can elaborate a bit in terms of how are you managing to improve gross margins and also continue volume growth? Is it more a function of product mix, or is it cost savings which you are enjoying through your integrated operations? If you can elaborate a bit on that.
Actually, you can see that in 9 months the gross margin improved due to product mix and due to cost reduction also. And last year we started our additional capacity, and the machines are very new and imported one, and so that the efficiency of the machine is very much than the old production machines. And other than this, in last 6 months we also have the volume growth around 11% in this thermal also. Thermal is a high EBITDA margin product, so there is product mix also. The improvement of 90 basis point in this quarter is due to product mix and due to cost control also. And in this GP margin, you can also that due to some our procurement, due to procurement we procure cotton at good rate and at very reasonable with our competitor, because only we have the backward processing in this segment. So this extra benefit to our company is reflect in the gross margin reduction improvement.
In terms of operating cash flow, the operating cash flow was about 47 crores in the first half. Is it possible to share what has that number been at the end of 9 months?
Currently in 9 months, my speech I already told that around 60 crore is the operating cash flow in 9 months.
In terms of price hikes, is it fair to say that in the last 18 months, including dollar, the industry would not have seen any price hike in the last 18 months?
So last 18 months, in our industry, no one took a price hike as such, and we are very hopeful that with this tariff thing going down, and now Tirupur as an export hub, the yarn demand will increase, and it will give some push to the industry with respect to some raw material prices going up, and maybe we'll be able to take a price hike then.
So there is a very high correlation between yarn prices and your end product prices, right?
Definitely, because 50% of our raw material is the yarn.
Total cost.
total cost of production. 50% is contributed through yarn. So that is the main thing which actually lead to price hike or non-hike.
Lastly, sir, if I look at your subsidiaries in this quarter, there seems to be a loss. So, is it that you are on a hiring spree? I think that is mainly your railway business. If you can give a small update in terms of what's happening there, what's the size, what are your plans maybe in the next 2-3 years, that would be helpful.
So our subsidiary Dollar Garment is basically in the rainwear segment, and our segment, rainwear segment, is the seasonal only. The season for the rainwear is from January to June. So quarter 1 and quarter 4 is the in this subsidiary we have the revenue increased, and quarter 2 and quarter 3 is generally there is no such requirement of the rainwear product. So in this quarter 4, we hopeful that last year in this subsidiary our around we have the total turnover around 37 crores is there, and this year we hopeful that we have the growth of around 12 to 15% in the overall segment, and already we completed the 15 crore in the quarter 1, so balance we cover in the this quarter. Other than this, we have the target that within 2 years we reach we cross the 3 digit in our revenue in this segment. So we very hopeful that we get our target achieved.
And here the margins will also be far superior, right?
In this segment, our EBITDA level margin is around 18 to 20%. 18 to 20%.
Great, sir. Thank you very much, and all the best.
Thank you.
Thank you.
Thank you. The next question comes from the line of Anik Mitra from Phenomics Solutions Private Limited. Please go ahead.
Good afternoon, sir. Am I audible?
Yeah, audible.
Yes. Yeah. So my first question is related to that 9 proprietary companies which has been absorbed or which is going to be absorbed. So I would request you to throw a little more color into it. Means how will it matter or impact your overall performance in terms of margin, in terms of your revenue growth, as well as on your cash flows?
So we already filed the for the merger application with the SEBI, and we are waiting for the approval. The 9 companies which are merged into our industry, that is wholly engaged with the main company only, and mostly in out of 9 companies, 6 companies are related to the real estate company, which assets used by only our dollar industry only, like we have office and the factory. So once they are merged, our rent part which we had at arm's length price is also removed. And other than these 3 companies, one is the one company is holding the brand. So in our segment, in first we are the first hosiery company in which the brand is transferred in the main company, our Dollar Industry Limited. So our Dollar brand is also with our main company, and the royalty which we paid to the Dollar Brands Private Limited is also removed and from the cost part. And other than this, 2 companies is mainly related to job worker related. So job worker cost is also minimized, and the overall efficiency in the labor form and in the production capacity is also increased. So overall, we analyze around 5 to 7 crores of expenses is to be rationalized due to this merger, and more than this, the net worth of the company, inner net worth of the company, basically because due to the brand coming at very low price, at book value price. So net worth of the company, inner net worth, Dollar Industries increased.
Okay. Okay. Sir, as you said, 7 crore of improvement in terms of your cost. So will it be on quarterly basis or annualized?
Annualized.
Annualized 7 crore improvement. Okay. And
basically it lead to corporate governance also, because 90% of our RPT transactions are now reduced.
okay. Okay. And sir, any impact on your free cash flow in this transfer or takeover?
Free cash flow, mainly free cash flow, not much affected this. But due to this, as I told that we are the first hosiery company which own the brand in our main company. Other than all the hosiery company in our segment, is the brand is owned by other company, other entity, and they pay the royalty. So we are first in the segment that our brand in our company only. So whenever we introduce new products in our brand, so we don't have to pay any type of royalty to the, and somehow this reduce the ultimate cost to the company.
Got it. Okay. Sir, my next question is related to the tariff, which you were mentioning, probably Ankit was mentioning. Sir, I just want to understand, as you said, US tariff may increase the reduction of US tariff will increase the demand of yarn and prices will go up. So on this context, I just want to understand, means you will be able to take price hike, like will it be beneficial for you as the price hike will be taken just because of yarn price hike? So it will go to cater the increased yarn prices. So how do you get benefited out of it, out of the price hike?
Gaurav.
Yeah, I'll take this up. So what happens is, the US tariff coming down and everything. Currently, what we see in the export market, because I stay in Tirupur and, look after production over here majorly, what I speak to, a lot of exporters is, that now they have started taking goods which were with them kept in customs department or in their warehouse as of now. So for now, we are not seeing a lot of differences in the cotton price because they want to liquidate the old ones. And if the export market booms after this because of, reduction in the tariffs, that is where probably after 4 months or 3 months, we'll come to know anything if there's a very high price hike in the cotton prices or raw material, but we do not expect to that level. We certainly expect maybe 10 rupees, 20 rupees here and there.
Okay. So 10 to 20 rupees per kg in yarn.
Yeah, approximately I'm telling about. It's just a ballpark figure. That is how the yarn industry, speaks ki 10 rupees बढ़ गया, 15 बढ़ गया. It's like that. So, the yarn market might become a little tighter for sure, but we do not expect it to become way tighter. What happened during COVID and everything, that the yarn prices shot up by say 30%, 35%, So that is not the situation we are going to get into anymore.
Okay. And like as you were referring, US tariff reduction, simultaneously US has already removed the tariff for Bangladesh. So will it impact anyway to our yarn prices?
So no, not really. So what latest information what we have is it might be extended to India also as of now. The same, if you use US cotton, the tariffs go lower. So it might be extended to India, but we are not very sure about it. If it might get extended, we might see a change. And we have a spinning mill of about 45, 46 ounce spindles. So we are very, very well covered with that also for this quarter of the yarn. Because of the backward integration, we are much in a better space.
Okay. But in case tariff remains same, but for Bangladesh it is zero duty at this point in time. So what would be the impact? Like, will it again go back to like where we were?
I'm sure some demand might get diverted to Bangladesh if the tariffs are, because Bangladesh is a very good country to, manufacture, and the prices are already lower there. And with tariffs coming down, I'm sure a lot of people will want to shift there. But that is something that has just happened, and I'm sure Indian government will also be working towards the same. So, that our industry does not get affected too much.
Okay. Thank you so much.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments. Thank you, and over to you, sir.
I would like to thank you all for taking the time out to join the earnings call. Have a nice day. Thank you so much.
Thank you.
Thank you, everyone. Thank you.
Thank you. On behalf of Anand Rathi Share and Stock Brokers Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.